Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleague, Kali Sirugudi, from our residential mortgage-backed ratings team. Today, we will be covering the topic of the Dutch housing market. House prices have started to decline in the Netherlands as interest rate rises and affordability issues begin to impact the market. A rapid post-pandemic rise can bring concerns for an equally rapid decline as demand dries up. Mortgage interest rates are back to levels not seen in over 7 years. However, a robust economy and unemployment picture could help to limit the impact on pricing pressures. Further, a still resilient and borrower-friendly market provides a supportive backdrop to existing mortgage borrowers. Now to bring in my colleague, Kali Sirugudi. Kali, how are you?
Hi, Gordon. Thank you for having me.
Great, Kali. So first, let's talk about the issue around the housing market in the Netherlands and how it has been behaving in recent times. Can you give us just an overall introduction into the way things are going for the house prices in the Netherlands and maybe a little bit of history or recent history in terms of their past performance?
So house prices in Netherlands have risen over 80% since the trough in 2013. 44% of this rise has been observed over the period 2013 to the pandemic in February 2020. Since the pandemic, house prices have risen by another 37% to July 2022. Now, given the high inflation, in real terms, house prices have risen only by about 18% during this entire period. The average annual increase nominally is about 12% since Jan 2000. And that gives you a flavor of the support the housing market in Netherlands has experienced. The headwinds to a further rise in house prices include not only the relatively high inflation, but also the rising interest rates. So KBRA expects pricing degradation to likely continue with a number of supportive factors that put a floor on declines, particularly on an inflation-adjusted basis. These factors include a mortgage financing market supportive of home ownership, low level of house building relative to demand, and high rental rates. So the Dutch mortgage market is fundamentally supported by high leverage, the energy guarantee, and the mortgage lending code of conduct. If you look at just the energy guarantee in recent times, that has increased to 4,000 and 5,000 euros. And if you look at the market in general, over 61% of the Dutch population now has a mortgage loan compared to 27% across EU. The mortgage outstanding as of Q3 2022 stands at 797 billion euros, of which you have 195 billion euros mortgages outstanding as guaranteed by NHG. And that illustrates to you how the mortgage credit supports home ownership in Netherlands. As regards the highly leveraged housing market, this has been incentivized by the government through interest tax relief. Now, interest tax relief in itself and the rebate has reduced, which now stands at 37% of a homeowner's annual mortgage interest paid. Now, this was over 50% before changes were made in 2013 to a lower tax deductibility. Dutch mortgage market also shows unique mortgage products combining interest-only mortgages with savings products and other types of products to maximize the tax benefit. Now, borrowers need to have an annuity or a linear mortgage to qualify for interest deductibility, where the loan amortizes over the term. Regulation has also curtailed the maximum allowable lending levels. So lenders used to be able to provide borrowers with a mortgage above the value of the home, but it currently stands at a maximum of 100%. Now, that could potentially be an issue if house prices decline. There could be a certain cohort of the borrowers where the loan is in negative equity
Great. So obviously, with higher amounts of leverage, interest rates are going to be a big driver for the recent declines in house prices. Kali, maybe you can take us through a little bit of how mortgage markets are behaving with regards to mortgage rates.
Certainly, Gordon. So KBRA expects the ECB to proactively raise interest rates to tame inflation. And we've seen this in the recent past, and inflation has been persistent, though you do see across other European jurisdictions where inflation seems to be going down, but rising again. So interest rates can, in general, be expected to rise further from the current levels. Now, rising interest rates have reduced the demand for mortgages in Netherlands, like also seen elsewhere in Europe. Interest rates on offer in Netherlands have increased to an average of 4% currently, from a low average of 2% before interest rates have begun to increase. If you specifically look at the floating interest rates, now floating rate mortgage interest rates were about 3.9% in Jan 2023, which have increased from their low of about 1.8% in May 2021. If you look at the fixed rates on offer for 10 years or more, the average rates of interest are currently at about 3.3%, up from the low of about 1.6% in December 2021. So floating rate mortgages, which are about 6 to 18% of the mortgages completed, certainly show to be a meaningful proportion of the mortgage origination in Netherlands, but certainly will be affected by a further increase in interest rates in terms of their overall share of mortgage originations in Netherlands. Rapid rise in rates have placed enormous pressure on demand, with first-time buyers particularly. The first-time buyers do benefit from some breaks, such as tax-free gifts from parents and a transfer tax exemption, but the increase in interest rates and affordability will continue to pressure demand from the sector. For buy-to-let mortgages in comparison, of course, there's an increase in transfer tax, which came into effect in 2023 to 10.4% from 8% before. And there is also a cap on rental rate increases. This will affect the demand for the buy-to-let sector. But the low levels of property development and high rental rates should continue the appeal for the buy-to-let product.
Great, thank you. So if we are facing higher mortgage rates and they continue to remain elevated, what does this mean in terms of performance in the mortgage market? How has that been progressing, and what are your expectations going forward?
So Dutch mortgage market is characterized by relatively low delinquencies and defaults historically. Now, the key aspect of the Dutch economy being the low unemployment rate is supportive of mortgage performance now and going forward. The other factor supporting performance is the high proportion of mortgage outstanding, which are on fixed interest rates. Now, KBRA in general expects small increases in delinquencies, particularly from the cohorts paying a floating rate of interest, or where borrowers need to refix interest rate at the end of their fixed rate period. If you look at the KBRA report, we've been able to bring out the performance historically to where it stands now, where you will see that the prime mortgages have delinquencies which are lower currently, where the proportion of mortgages above 90 days in arrears is at about 0.07%, while that for buy-to-let mortgages has fallen even lower at 0.04%. There is a small proportion of the outstanding in Netherlands where the mortgages were given to borrowers with adverse credit history. So this is a non-confirming mortgage space in Netherlands. Now there, relatively the performance has been worse, but delinquencies there for that part of the market have fallen to 0.9% as of December 2022. The delinquencies in comparison to where they are now were at a peak of about 12.5% in March 2013. So in general, the Dutch mortgage performance can be relatively stable as compared to other jurisdictions in Europe, but can see small increases in delinquencies and defaults.
Great. Thank you very much, Kali. So, as highlighted, house prices are likely to continue to come under pressure with elevated interest rates and inflation presenting headwinds for borrowers to meet affordability measures in the Dutch mortgage lending criteria. As a result, house prices are likely to continue to slide as demand and affordability weakens. This presents risks to those that have taken out mortgages in the last several years with high loan to values in the Dutch mortgage market. And borrowers taking out new loans in the past several years are at risk of potentially being underwater. On the other hand, there are supportive elements to the housing market in the Netherlands. Many will benefit from low mortgage rates that have been locked in for lengthy terms before the rates began to rise. And also, using the affordability measures should mean that they can continue to afford their mortgage payments even as rates rise. And low levels of unemployment should further keep delinquencies from increasing. KBRA has been actively monitoring the development of this market, as you can find in a report that is published on our website. Make sure you are registered to receive our latest commentaries and have subscribed to our podcast, and of course are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you all out there as we face interesting times.